You know that sinking feeling in the pit of your stomach when you check your portfolio and see nothing but red? Yeah, you are absolutely not alone. Welcome to This Explainer. Today, we're going to tackle the big, bad world of market crashes. But instead of panicking, we're going to reframe how we look at these fluctuations. We're going to transform that fear into a concrete, actionable strategy by looking directly at the hard data behind market cycles. Okay, first things first. Have you ever actually stopped to wonder why we let zoo animals dictate our financial feelings? I mean, bulls and bears. It sounds kind of like a punchline, right? But believe it or not, the everyday lingo we use on Wall Street has some seriously wild, centuries-old origins that perfectly explain the psychology of investing. Here is what we're covering today. First, the origin of bulls and bears. Second, a history of market cycles. Third, the anatomy of a bear market. Fourth, strategies for market downturns. And finally, spotting the market bottom. Let's get right into it. All right, Section 1, Origin of Bulls and Bears. So this is actually fascinating. The term bear takes us all the way back to 18th century London. Picture this. Traders back then who were basically practicing naked short selling were playfully dubbed bearskin jobbers. Why? Well, it comes from an old proverb about selling a bear skin before you've actually caught the bear. Makes perfect sense, right? They were selling shares they didn't even own yet, just crossing their fingers the price would drop before they had to deliver them. In fact, author Thomas Mortimer wrote way back in 1761 that these bears would just scramble around devouring any shares they could find to close out their positions. And then on the flip side, you had the bulls. These were the total optimists, buying up excess shares, often on credit, just completely convinced the market was going to charge upward. But hey, fast forward to today, and we've ditched the 18th century slang for strict math. It's pretty cut and dry now. A bull market officially kicks off when stocks rise 20% or more from their lowest close. On the flip side, you get a bear market when the index closes at least 20% down from its previous high. So it's that precise 20% swing that decides if we're dealing with a charging bull or a hibernating bear. Moving right along to Section 2, a history of market cycles. When you're stuck in a bear market, it honestly feels like it's never going to end. But the data tells a completely different story. If we look at historical returns since 1942, the average bear market is surprisingly brief, just 11.1 months. That's less than a year. Now sure, during that time, the average cumulative loss is 31.7%. And yeah, a 31% drop over 11 months definitely stings. But we have to remember, it is a temporary state. Fun fact, since World War II, the US has seen 13 bear markets, and literally every single one of them has eventually ended. Now look at the flip side. Get this. The average bull market lasts a massive 4.4 years. And over those 4+ years, the average cumulative total return is an absolutely staggering 152.8%. It's huge. So while bears give us a quick, sharp pain, bulls bring prolonged, massive gains. To really put this into perspective, just look at how this plays out over time. Notice how those massive blue mountains of bull market growth just totally dwarf the tiny orange dips of the bear markets? When you zoom out, the big picture is undeniably trending upward. Those little orange dips, they're nothing more than temporary speed bumps on a long-term trajectory of growth. Seriously, this right here is the visual definition of why patience pays off. Which brings us to Section 3, Anatomy of a Bear Market. Even though they're short, bear markets still hurt. So what actually causes them? Well, historically, major bear markets don't just pop up out of nowhere. They're almost always tethered to massive global events. Think about 1929. The Wall Street crash wiped out 89% of the Dow's market cap and kicked off the Great Depression. Or jump to 2008, when the housing bubble burst and triggered a brutal 517-day bear market. And of course, the 2020 COVID-19 lockdowns, which sent an instant shockwave right through the system. The big takeaway here is that a bear market hits when some major shift in economic conditions sparks widespread fear. Maybe it's skyrocketing inflation and interest rate spikes, like we saw in 2022, or maybe it's an asset bubble bursting, like the dot-com crash in 2000. Ultimately, these triggers tank corporate profits and shrink valuation multiples. Poof! Investor confidence evaporates, money flees the stock market, and it usually gets parked in lower-risk assets or just sits around as cash. Let's get into some tactics in Section 4, Strategies for Market Downturns. Since bear markets are literally an inevitable part of the economic cycle, how do we actually handle them? Well, the absolute worst thing you can do is panic sell with the herd. If you sell, you are literally just locking in your losses. Instead, the financial experts at TD Bank suggest playing a little defense. First up, tune out the noise. Don't obsess over the doom and gloom headlines. Second, make sure your portfolio is well diversified to soften the blow. And third, look for defensive companies with wide moats. Basically, a moat is just built-in protection against the competition. Think heavily regulated, essential stuff like telecoms, utilities, or banking. These guys tend to keep pulling in consistent profits and paying out dividends even when the economy is struggling. Now, taking that defense a step further, let's talk about a fantastic wealth-building tool called dollar cost averaging. Look, guessing the exact market bottom is completely impossible. So instead of trying to time it, you just set up automatic regular contributions. You invest the exact same dollar amount every single month. By doing this, you naturally buy fewer shares when prices are sky high, and this is the absolute best part. You automatically scoop up more shares when the market puts them on clearance during a downturn. You're literally automating the buy low rule without even having to think about it. There's also another really savvy move, especially for your non-registered taxable accounts, and it's called tax loss harvesting. Let's say you've got a stock that's just tanked, and honestly, you don't really see it rebounding. You can actually sell that investment and take the capital loss. Why would you do that? Because the silver lining is you can use that exact loss to offset your other taxable income for the year. You can even carry it forward to future years. It's a really smart way to wring a tangible tax benefit right out of a market drop. Finally, let's hit section 5, spotting the market bottom. So how do we know when the worst is actually over? There's an old quote from Baron Rothschild. He said, "The best time to buy is when there's blood in the streets." Morbid, I know, but it just means you should buy when investor sentiment is at its absolute lowest. Now, you can't perfectly time the mathematical bottom in real time, but you can look for the economic clouds to start clearing. What are the signs? Well, look for consecutive months of job gains after a string of layoffs, look for inflation cooling back down to a normal 2 to 3% range, and ultimately the definitive, undeniable sign that the bottom is behind us. That is when the index officially gains 20% from its lowest close. Bam, a brand new bull market is born. So, keeping all this data and strategy in your back pocket, I want to leave you with one final question. We know the next market downturn isn't an if, it's a when. It is absolutely guaranteed to happen. But when it does, are you going to panic with the herd and lock in your losses? Or, armed with every